Welcome to the Trader's Desk. It's the 13th of July 2025. Before we get started, this is not financial advice. This is purely for educational basis. Do read the disclaimer and also do read the copyright notice. Quite an interesting week where it looks like sanity is back. We had a short trading week last week, only 4 days, and then as we came back into this week, there was a little bit of I would say maybe profit taking. One of the things we have to understand is what lies ahead, and we're going to be having earnings season in a couple of weeks. So it does make sense that a lot of people are taking some chips off the table, especially, with the moves that we've seen in the market. But most interestingly, as we'll see later, the yield curves are also moving in the opposite direction as in the last couple of weeks. This is something that definitely impacts the risk on risk off behavior in the stock market. So in the S&P, we did not make a new high per se. At the moment when I look at it, there's not much I can say. Is this like a reversal signal? It's too early to say. Um, a same type of pattern in the QQQ. Nothing much to read from these two. But it's important to know that we are very close to all-time highs, and we have to understand this is a bull market. We have to respect it, and we have to understand what happens in a bull market, behaviors of financial participants, and all of that. Yeah. So one of the traps that many people fall into is that they think that okay, we're at all-time highs and the market cannot go higher. So I have to be bearish in my portfolio. And this is like the cardinal sin for retail traders. They always think that they are the ones who are going to call the top in the market. And it's very different from how professionals look at it in terms of professionals will never tell you, this is the top. They'll just say, look, this is the situation at the moment. Given what I'm saying, this is what I'm doing. And if it's the top, fine, I'm going to have some hedges. If it's just going to grind higher, I've got stock ideas that will help me participate in that move. So retail traders tend to be far more confident and far more erroneously confident than professional traders who have the humility to accept that they cannot predict every single tick in the stock market, especially when it comes to turning points. No one really knows, and they accept that. The only thing that they do is they say, okay, this is the situation. If that's the case, I'm going to plan my portfolio accordingly and not try to be a hero by calling tops and all of that. So, as we've had this phenomenal V-shaped recovery, a lot of people, I mean, I'm interacting with retail traders all the time. A lot of people just cannot understand that the stock market is rallying, and along the way, they are just positioning themselves for more pain by being bearish and putting themselves in a position where they want to be the hero for calling the top in the market. You don't get paid for calling the top. In if anything, you're going to lose a lot of money, confidence, and whatnot by trying to predict the top, and then it never happens, right? So that's a little bit of a mindset change that needs to happen. We always need to have the humility to say to ourselves that we don't really know what's going to happen next, right? What we are able to do, however, is to assess things on a macro basis and assess industries and stocks on a fundamental basis, and then identify areas where there might be price dislocation or areas where there might be a potential for maybe a stock to pull back meaningfully because of something that might happen ahead of time. Like, let's say, if we have an inflation print that's off the chart, right? We can think of many stocks that will pull back 10, 20, 30% easily, right? Um, this is the kind of thinking that professional traders do. It's more probabilistic, it's more scenario driven, and very less, ego driven or trying to be the guy who, predicts the tops and bottoms. At the end of the day, we all understand that, we're going to be wrong on many our calls, but when we are right, we want to make a lot more money than when we are wrong. So that's the asymmetry that we're always seeking. Moving on, when we look at the equal weighted version of the S&P 500, so it's not been the best of weeks. So as I was mentioning, I think that's a little bit of profit taking happening there, but also I think the long-term yields are having a big impact on many of these stocks that are not in the Magnificent Seven. As you can see on the right, the Magnificent Seven just kept rallying. So it just keep pulling ahead, irrespective of Tesla, Apple being, not the best in terms of fundamentals, but the likes of Nvidia just keep pulling everyone ahead. Um, and you have to ask yourself how much longer is this gonna continue? And if it does, right, what does it mean? If we have a reversal from this point here, uh, what are the opportunities for you, right? So the RSP, this looks like a reversal signal to me, to be honest, but it's maybe too early to talk about that or to be confident that this is a reversal signal. It can go much higher, um, and there's nothing that we can say. At the moment, if I say, okay, this is gonna go down for the next few weeks, it's just going to be like a hunch and probably not something where, I have a high conviction, right? But nonetheless, it's something that I look at and on a week to week basis, I keep monitoring this just to understand what's driving the underlying financial markets. Is it the Magnificent Seven in this case? Yes. Or is it the broader market participating? So last week, or at least in the last 2 weeks, we've had big participation from the wider stock market, right? So the RSP, you could see two big green candles. And then this week, it gave a little bit of these gains back. So, nothing much I want to read further into this. I'm just going to let it develop. And, if eventually it pulls back and we find real signals of exhaustion here, uh, there will be a lot of opportunities to, get back into this and, position ourselves a little bit short on some of these companies. So the IWM, we spoke about this last week. Again, not much of a great week. So if we look at the candle for this week, it's been a little bit like let's try to make a new high and then a lot of sell-off. So basically people taking profits. Um, Generally, this would tend to happen, right? Whenever you're trying to make a new high, because people who've been in the trade earlier would tend to think that this is a good time to take profits, whereas people who, you know, haven't managed to get into the move, they might have a little bit of FOMO as the market keeps grinding higher. So, it's a bit of a tug of war between the two. And eventually this is what we've got. It's a bull market. I'm not going to say, we're going to see a reversal here, but this is something to keep watching out for. Um, the IWM has not been rallying for, or at least it's been underperforming the S&P 500 for quite some time. I think if you've been following from last year, we've been waiting for the IWM or the small caps to start participating meaningfully, and they've consistently underperformed the S&P 500. So capital has been moving towards, these big tech companies which operate a little bit in a winners take all type of environment. So that's the reason why we haven't seen the small caps outperform the S&P 500. But it's also something we have to think about, right? Let's say if you're willing to take slightly longer time horizons and transition a little bit into an investor, I think you can find a lot of opportunity within the IWM or, you know, the respective small caps stocks. But at the end of the day, it's down to you to figure out how you want to approach the market. Some of us who just want to trade options might find limited opportunities within the small caps because not all of them have liquid option chains. So at the end of the day, it's really for us to decide how we want to go about this. Um, in terms of the momentum-driven stocks, we had a little bit of a reversal. So the last 2 weeks have been a little bit tepid after massive moves in the previous weeks. So as we discussed, the momentum stocks have been leading the market too, right? So we've seen many stocks within tech which have been up 10, 20% in a week. And these would tend to be within this momentum ETF. Another thing that we watch, right, just to understand what's driving the market. And generally, when we see these momentum driven stocks, stalling, um, then we have to really be careful to pick some of these FOMO stocks, right? So, for instance, if you've been watching a couple of them, uh, Rocket is one of them that me and Bhavan have been looking at. So, if we had pulled the trigger 2 weeks ago, we would have, just been caught off. We would have bought it somewhere around 15 and above, and now it's trading, I think, 13.5, somewhere there. So you really have to make sure that you don't succumb to FOMO sometimes and it's difficult, right? Because you see the situation, it's lining up, right? You can see the big short interest and you can see the stock rallying crazily. And you just think to yourself, wow, tomorrow it could be another 5, 10%. And if I don't get in now, I might miss the whole opportunity. But then more often than not, right? You would tend to see that this would have been a bad idea. So in this case, Bhavan, I mean, I'm sure you would agree with me. It paid to not pull the trigger and to wait a little bit. Um, and all of these, let's call it the profit taking or slight reversals that we are seeing, it's actually being driven by one thing, right? The US 10-year yield just reversing from this downtrend that it was on for a few weeks. So, if you've been in the markets and following all the narratives, there's been a lot of rumors about, you know, Powell resigning or just about to resign, and a lot of talks about, and from the supreme leader himself, right? Who says that Powell is late and he should have been cutting, and other countries have already cut so many times. And this week he said that we should be at least 300 basis points lower from where we are. So that's a lot of pressure and a lot of narrative peddling that's happening in terms of leading the market to believe that eventually Trump will have his way and you know interest rate cuts will come. So there was a lot of speculation that they would come as early as end of July, which is the next Fed's meeting. And then once we had some strong data points in terms of employment data and also the PMI data showing higher prices, so higher price indices rather. So um, the market was very quick to sense that this is all bullshit, right? And if you default to what Powell has been telling us for a few months, right? His way of thinking about it, he's outlined it quite eloquently, right? It's been a little bit of a feature of this market whereby Powell is actually being quite transparent in terms of how he makes decisions and what he's looking at. But then the market will second out him and think that, he's just bullshitting everyone and he will do something totally different. And that's been happening for, the last couple of years, actually. At every meeting, they would second guess what Powell will do when he says this, he actually means the total opposite. But actually, if you were just listening like a 6 year old and just took his word for it, you'd actually be right in terms of all the decisions that they've taken, in terms of predicting all the decisions that they have taken for the last 2 years, because Powell has actually been quite transparent and consistent in terms of what are the macroeconomic releases that he's watching and what guides their decisions at the Fed, right? So the market has this feature whereby, you know, at certain point in the week, it's going to become like the flavor of the week that everyone will turn dovish on nothing, right? Maybe just a tweet from, someone just pushing another narrative in the market, or one of the Fed presidents just coming out and saying that they believe they should be cutting, or that if it were down to him or her, that they would be cutting. Um, and it's quite funny, right? Because when you read the FOMC minutes, then that same individual agrees with everything that's in the minutes. So I don't know what to call this, but it's definitely not, it's definitely not, uh, what's the word? High integrity, right? Because if you sign some document and you say you agree with it, you vote for it, and then you come out in public and say something that's contrary to what's in that document, I think that's a little bit disingenuous, right? But that's what I think, right? Not everyone operates in the same manner. And unfortunately, all this nonsense affects financial markets for weeks, right? So what happened in the last 2 weeks was that we've seen a big reversal in the US 10-year yield. It might seem small here, right? But the guys who trade equities, especially, all these high PE or tech equities, they know that this is like a landslide move, right? Because, for instance, Talha, right? Like, we were looking at Oscar Health, right? 2 weeks ago, it looked like an amazing long opportunity. And then 2 weeks later, it's almost like the market doesn't even want to look at this name, right? So it goes from, uh, I think 3 weeks ago, it was trading around 21. Now it's probably trading around 16. These are massive moves, right? If you look at it in terms of percentages. So you know these names have a lot of volatility, and a lot of this is driven by what's happening to yields. So depending on what's your view on where yields would go, um, you could position yourself long a lot of these stocks and think, basically the statement you'd be making is, sooner or later we'll get the rate cut, and eventually, there will be like a narrative out there in the market that leads the US 10-year yield to go a little bit lower, like, Trump threatening to sack Powell, something of that nature, right? And that's just going to give your long tech or long shitty tech ideas like a massive bull run. That's one way to look at it. Another way would be to say, look, right, I don't want to be playing along these narratives. Let's get real. Let's look at the data and think where things would actually fall into place, and, take a different view. Um, then you'd be doing things like short housing, short, some stuff that are long duration. Um, but I think my point later in the presentation, I'm going to bring this about. My point is also, why not be both, right? Because you don't really care, right? If position one is a little bit like, yeah, the Fed is going to cut, it's going to get so dovish. And then position two is completely opposite. It's fine to have that, right? It's not you flip-flopping or anything like that. It's you just being responsible with your portfolio, and also being cognizant of all these narratives that are out there in the market that are moving things quite significantly, right? So if there is a bullshit narrative, it makes position one go much higher. You take profits and you move on. And as we revert back to reality, then position two would likely either break even or make you some money, or you could even lose some money. That's not a problem. But at least, irrespective of what happens, you still come out winning. That's the most important thing, right? Because we don't know what's going to happen next week. There might be some talk about tariff. There might be some talk about, I don't know, maybe physically they are taking Powell out of the Fed, right? Because he said he won't resign on his own will, right? So, you know, a tweet is free. Posting on social media is free. So anything can happen. And it's not only free, but it's also free of any consequences. So, for instance, the president can say anything he wants, and it's total impunity, right? So no one's gonna come back at him or keep him accountable, right? He posts like, let's say if he posts 2,000 tweets in his tenure, no one's gonna go back and say on tweet 149 you were irresponsible and all of that. It's all gone, right? It's like short-term memory. So a lot just to say that be very careful of all these narratives out there. Some people have, unfortunately, a lot of, you know, power to move to spew these narratives that moves markets quite significantly. And as much as we would not want to follow these narratives, we have to sometimes just to understand and put things into context and understand whether we are wrong in terms of our views or if it's just like a short-term nonsense move that's happening on the basis of a tweet. Okay, I wanted to show you this as well. You can find this on Coifin. It's quite easy to find. I'll show you later. But this is the yield curve, right? And it's the yield curve on two different dates. The orange line is the yield curve as at Friday, and then the purple line is the yield curve as at so this is the 27th of June. So we're talking 2 weeks ago, right? Um, as you can see, right, there has been a meaningful uptick in the yield curve in terms of both the short-term interest rates and also the long-term interest rates, right? So in other words, the price of money became a lot more expensive over these two weeks. What matters here is the move itself, right? Because as this curve, as these rates go lower, then all these long duration assets, tech, profitable and unprofitable tech, they get a life of their own and they start rallying like 10, 20, 30% in a couple of days. But the opposite is also true, right? As the yield curves, the rates move higher on the yield curve, then it's almost like you're deflating a balloon. You're just taking a pin and then sticking it at the balloon, right? So a lot of these stocks have meaningful downside when we see these types of moves. So if you were to look at the last 2 weeks, as we've just seen, within the major indices, it's not that apparent. But if you were to look at, one stock, we can even look at, let's say, Oscar Health, right? Like I said, right? Let's maybe let's maybe just look at the price action here. So this stock in the last 2 weeks, right? So this was trading around 22. And then now it's okay, it's even fallen to 14.38, right? I thought it was 16, but it's much lower. Um, I mean, that's a phenomenal move, right? Like, what would that be? Um, it's like a 30%, 35% drop. right, from the highs. And that happens in the space of 2 weeks. It's a 3 billion market cap, right? Definitely, a little bit techy, right? So this is the type of move that you will expect to see in a lot of these stocks when you have the yield curve going higher. Or not going higher, but the rates along the yield curves moving higher, right? There's two things, right? If we say the yield curve is going higher, it might mean the shape is changing, right? But when I'm talking of the rates getting higher, I'm basically talking of transposing the same curve and moving it higher without necessarily changing the shape meaningfully. So these are two things, two totally different things. In this case, it's basically just the rates going higher. And the reason this is important, right, is let's say we were somewhere here, right, and you're looking for long ideas in your portfolio. You might be quite tempted to say, okay, this stock, it's got some momentum. Let me just, buy it. It's got good fundamentals and all of that. Let me just buy it somewhere here. And then 2 weeks later, you're nowhere to be found, right? It's like we're like 30% lower. So you're like seriously out of the money. Uh, and you could be here at this point and you're like, okay, I'm looking for a short trade, right? And it might not be in Oscar itself, it might be in a totally different stock, which has the same profile as Oscar in terms of it being maybe high PE, uh, not yet profitable, and that type of like low end mid cap that has these types of volatility profile. And let's say you identify that there is a risk that maybe the US yield curve the rates will go higher, but also within the stock itself, you identify a couple of fundamental drivers that would point to it, possibly being um, bearish, right? So at this point in time, you could say to yourself, look, the US yields have gone down meaningfully. So if I wanted to protect my portfolio versus the yield curve, just reversing and going back higher, this would be a perfect short trade to have, right? So of course, you would never know, right? When you're looking at the stock here, the last thing you want to do is to short it. But a lot of these stocks, if you do your work on it, you would realize that there is a short opportunity here, and as much as at this point in time it doesn't look intuitive, you'd be right to actually short the stock there. But it all falls back on understanding, how the yield curve moving up or down will actually impact these types of stocks. So at the start, Bhavan, you were asking me a question about this particularly, right? And I hope this maybe gives a little bit more context to what we were discussing. And if you have any questions, just feel free to unmute and let me know.
No, it's clear, Prashant. Thanks.
And it's quite interesting that all of this happens in the space of 2 weeks. Yeah. Normally, these types of moves, you probably will see them over a month with major fundamental economic releases having changed consensus and all. But because of all this narrative, right? These are just moving so much, and it's not many people write about these things. Not many people pay attention to this. But as traders, we have to be very acutely aware of these points. Uh, yeah, go ahead, Bhavan. You have a question?
Yes, Prashant. So for the Oscar Health,
Hmm.
I haven't read the thesis, unfortunately. But
It's a
if
good
it
one.
if
I think we should all read it. There's a lot to learn from that. And thanks, Stella, for putting it all together. There's a lot of moving parts for all of us to learn. And I'm not saying it's a short, Um, its time will come, but probably it's not yet the right time to pull the trigger.
Okay. So my question there is like, is it just a yield curves move that is causing the stock to come down, or is it also fundamental? So it's a combination of the both.
No, I think my view is when you have crowding in a stock, right? So if we go back to the stock, right? So let's take a daily chart. So earnings were here, right? And then somehow everyone wanted to get bullish around here. Yeah. And that was predominantly because all these tech stocks were breaking out, the mid cap growth and everything. So people were using Oscar Health as a proxy to participate in that whole move. Yeah. So you can see, right? This is a big move. We're moving from 16 to 19 in one day. Uh, it's a big move. It's a big daily move, right? And then the next day, this things opens much higher. Like it opens at 22. So it closes at 19 something, opens at 22. So that's a big gap risk. On zero, you know, maybe there was like some news or something, right? But this is basically just people chasing the trade, right? It's a lot of crowding that's happening here. You remember we saw the same thing on C3.ai. It goes from 25 to 40 to 45, 47 just before earnings and on the basis of pretty much nothing. So that's a lot of chasing that happens. So you have retail traders buying options and trying to be in the stock. Uh, the stock very quickly gives back all the gains. Then over the next few days, it's kind of consolidating. But basically, what's happening here, a lot of these guys are taking profits, right? And then eventually one day it opens like significantly lower. So there are no buyers of the stocks, you know? 2 days ago, it even got a downgrade from Wells Fargo. So typically, if there was no chasing, right? If there was not like a lot of people on one side of the boat, maybe this downgrade would not have caused a big sell-off. But as there's a lot of people on one side of the boat and they're all expecting, to see the light, right? And then, day after day, the stock is probably not rallying and there's news that's coming that's, not necessarily positive or aligning with their views, which is basically that the stock will go much higher and they will make a lot of money on it. Then they start panicking, right? Then they reverse all these long positions get sold, and when everyone's selling at the same time, it's even more violent than when people are chasing on the up. Yeah. So somewhere here, people realize that the yield curve is reversing, and then it's looking a little bit risky, right? If the yield curve grinds higher, then it's going to be a bit of a problem for these types of stocks. So some stocks actually kept they retained the gains. So this is Magnite, massive rally, right? So from let's say from here, right, it made a new high, tried to consolidate, then just broke much higher. So it was kind of trading around 17, then it went all the way to 25. And this is also like a mid cap, right? $3.2 billion. For those who don't know about this stock, it's basically a company that has technology for bidding of ads on Netflix and all these OTT platforms. So um, it helps to um, automate this whole process around bidding and basically deciding what ads will be shown on these OTT networks. Yeah. So if you look at this stock, right, it went all the way to 25. It's now back to 22, but it hasn't had like a big down move, right? It's not like they just gave back all the gains. So this type of price action tells me that a lot of the people who are in the stock They don't really care that it's gone down a little bit. They don't really care that the yield curve has gone back up a little bit. And they are looking more at the fundamental prospects of the company. So they are willing to hold the stock and not sell it, even if we've had a little bit of a down move here. So it's possible that, we go like on a big sell off here like this. But at the moment, if I look at the price action here, compare it against something like Oscar, for instance, this one's basically just given back all the gains. And it's possible that this would go even lower, right? If there are still a lot of sellers. So different stocks react differently. And a lot of times it would come down to the type of people who are holding it. So if you have retail traders, they tend to be a little bit more fickle, right? So the moment the stock goes down 5%, they will start selling, and they are like what is typically referred to as weak hands, right? So they have no conviction on the stock, and if the stock goes up, they get really happy. If the stock goes down a little bit, then they start panicking and they sell. And if the P&L goes from positive to zero to negative, then they just like they lose their heads, right? So it's also important to understand, right? These types of stocks, who are the holders, and generally when you have institutional holders, then they tend to be a lot stickier. They tend to buy after doing their homework properly. They're not necessarily as FOMO driven. So, these are the things that you always have to ask yourself. But yeah, essentially, if you had to summarize the last 2 weeks in one chart, it would be this one. Yeah. I cannot emphasize enough the importance of, this, what we're seeing here, the yield curve. Uh, I'll open the forum if you have any questions, if anything is not clear. Okay, looks like we all get it. Um, I think all of you have been in the workshop, right? So when it comes to the risk on, risk off behavior along that spectrum, you can clearly see this happening here, right? So as this curve gets shifted upwards, then we move a little bit. So we move from like crazy risk on to maybe risk on or neutral, or to maybe even risk off. Yeah. Anyway, does that answer your question, Bhavan? Is that clear? Is that like crystal clear why we see these types of price action?
Yes, sure. It's clear.
I think we see this in housing also, but housing is proving to be a lot more resilient. Yeah. So I think a lot of people are like, look, eventually we'll get the rate cut. I just want to be in, right? And even if that means that I need to give the trade 12 months or 18 months to play out, I think people are probably saying this is a good idea. Uh, I don't really think it's a good idea. I think they will eventually get found out by the market. But if we look at the housing or home builders index, so if we look at this, or the ETF rather, uh, it's been I mean, if I look at it on a weekly basis, I think Tala also has the same conundrum, right? Like it feels a little bit like betting against the market. Yeah. At least, when we had these free candlesticks just going up, it felt like, you were a little bit crazy to be betting against the market. Um, if I look at the price action here with the reversal at this 200-day moving average, I think this tends to give me a little bit of confidence that, maybe we'll see a reversal here. Some of the names have already reversed quite strongly. Um, Not this one. Let's look at this, right? Look at this one, the DHI. I think this is one of the largest home builders. Um, Toll Brothers is another one. Yeah. So maybe we wait for a couple more weeks to establish whether this is actually gonna stop here and reverse down. But it's giving us a bit of hope, or more conviction that no one's able to take this stock much higher from here. And if you think about it, right, and you say, okay, look, um, sooner or later the Fed will cut and interest rates will be lower than where they are at the moment. Combine that with the weekly mortgage data getting better, which it has been. So eventually, all the roads point to more houses being sold, and these companies, they should do better. They should keep doing well, at least, right? And you could tell yourself, look, I'm getting to buy this company at a 13 times EPS, right? Um, that's what the uneducated uh, investor would. That's how the uneducated investor would think about this. But the educated investor would look at the situation a bit differently. Sure, we might have rate cuts ahead, which would be a macro tailwind for these types of stocks. But let's go back to fundamentals, right? Let's go back to EPS, growth prospects, and all. Uh, we have falling building permits. So will rate cuts reverse that whole trend? It's possible. But at the same time, we also have high backlogs, right? There are many houses to be delivered. Um, how much of a cut would you require to get home builders to get the sentiment to change quite significantly in that they start applying for more building permits? I don't think it's just like a 25 basis points. I think they would need, you know, a lot of conviction that the Fed is going to go much lower, right? And at the same time, right, home building consumes lumber, copper, steel, um, a few other things, right, that are imported. And our dear president has been imposing tariffs on these, metals. So these guys find themselves in a situation where raw material prices are rising, home prices have kind of flatlined, right, and are starting to fall, which means that home builders don't necessarily have the same pricing power as they did before, right? And we saw this with incentives that are being given by home builders, right? They are having to increase incentives to move inventory. So they have high inventory, raw material prices going up, and there's no other way about this, right? If you have to buy local steel, or if you have to import steel, eventually you're paying higher. That's the way to see it, right? So these guys find themselves in a situation where they probably don't have pricing power. Input costs are rising, margins are going to get cut, and they have high inventory. So, is this the right place to be buying these stocks? Are they cheap enough to buy them for the long term? I think I doubt this, right? If you look at this stock, right, um, before 2020, it was trading around, 60 was the high of the stock. So are you buying this like at a relatively cheap price? I don't think so, right? I think that this could meaningfully correct, right? This could go all the way down below 100, even, as we start having a dovish Fed. Um, of course, maybe this is something I haven't mentioned, right? Whenever we're participating in a short trade, our job is not to get it from here all the way down to where it will bottom, right? Because we cannot predict tops, we cannot predict bottoms, right? Our job is to just participate in, this is the sweet spot, right? This would have been the sweet spot, right? Around here. So back when we did the workshop, I think it was probably trading somewhere here, right? So participating in this downside would be the sweet spot. then the market probably is giving us another opportunity here. And then if we have another ride back down, this is the sweet spot. And let's assume that it will bottom somewhere around 60. Yeah. So our job is not to ride this from 130 or 40 to 60. 140 to 80 is good enough, right? And then when the story is out there, everyone knows about it. And the stock is also um, much lower in that it becomes a much better buy, right? For long-term investors who want to just buy and hold. That's when we stop looking at it, right? We tell ourselves, right? Look, now it's basically us trying to force the trade because everyone already knows it. Everyone has already sold the stock. Uh, you're probably at the risk of long-term buyers and just coming and buying the stock from here onwards. So you're not going to be short very close to the bottom, right? Um, there is one stock that we can look at which we can use to illustrate this point. So this is BC, right? Brunswick Corporation. It's a boat manufacturer in the US. For those who followed, I've been short a few times this stock, right? So I think I started shorting it somewhere here, then participated maybe somewhere here. A few failures along the way because, as you can see, it moves sideways, right? And then eventually it just crumbled here, right? So someone big just capitulated here. But if you start shorting it here, right, at 40, you get taken out by these moves, right? So that's why sometimes you have to stay away from shorting things after a washout, right? Because it's not necessarily going to give you like a good risk reward, right? And this went from 40 to 60, so that's a 50% rise, right? Uh, Maybe if your view is that you can short it here, uh, yeah, possibly it goes back to 50, but I would probably leave this alone now because now interest rates are gonna probably gonna get cut, and a lot of the problems that they had kind of goes away. So unless you have strong reasons, you probably leave it as a short. But from 116 all the way to 40, there were many places you could have participated. The sweet spot is not shorting it here because everyone knows the story now, right? The sweet spot is shorting it somewhere here where you're aware of the moving parts and you know how interest rates are hurting them and they have high inventory and all of that story. Um, you're not very clever if you come here and you're starting to you know um, spin a tale about how this business is in trouble. I mean, I kid you not, right? Like this is March 2025 and then this is May 2021. So for 4 years, people have been selling this stock. And you come here and you're like, yeah, look at this stock. It has issues. Um, you're a bit late to the party. Yeah. Okay, let's move back to our slides. Do we have any questions? Okay, not really. Let's move on. So a little bit of sector performance. Maybe what I'll do is I'll prompt you with questions, right? And feel free, anyone can answer. So did we see a risk on or risk off move this week?
think it's a mixed one.
Yeah.
We have seen cyclical like energy and consumer
Mhm.
discretionary materials
Mhm.
being outperformers for S&P, but the utilities, healthcare is also outperforming, showing like it's a mixed one.
Yeah, so um, consumer discretionary, you know, um, marginally, right, outperformed the
Yeah.
S&P 500. But it's been up over the month, right? So I would probably say that we've seen a month, a week where we move from risk on to risk off, right? And energy basically recovered, right? Because the oil price recovered. But then if you look at the rest of the segments, materials, right, it outperformed, but it's like a very marginal outperformance. Industrial again, it's like zero point 0.5. You know, it's slightly outperforming. Um, and the ones like tech, financials, they massively underperformed the S&P, right? So basically, what happened is if you look at the yield curve over the last 2 weeks, this is actually playing out, right? Whereby it's a reversal of a lot of these moves that have happened. But then if you look at tech, right, it's up 6.6% on the month, despite being down 0.4% on the week. So it's just a small correction within tech. It's not like a reversal or anything, especially not at this point. If you look at consumer staples, I think this is a sector that we've been quite bearish on, right? We spoke about Costco and a few others. Uh, this is pointing us to think that there is more downside here. Um, because even if in a risk off environment, it did not participate. So typically, people would move to consumer staples as a way to hide, right? When you have the onset of a risk off move. But this is showing us that the whole segment is actually selling off, right? Does that make sense?
Yes, I don't know if it's right, but it looks like consumer stable, so it's a bit overstretched and coming back.
Yeah, yeah. So that's basically what happened, right? In the last few months, we've had a lot of defensive weeks, right? And a lot of capital just goes and parks into consumer staple stocks. And basically, what happens is these stocks go to valuations that are too stretched. And these tend to be boring companies, right? Selling toothpaste or, pizza sauce or chocolate sauce, condiments that you have in the kitchen. These are not stocks that would be rising. The revenue doesn't grow much faster than inflation in many of these stocks. And then the PEs are going higher, and it just doesn't. I mean, at this point, right? People are looking at this and saying, uh, it doesn't make sense to keep buying these companies. Yeah. It's quite interesting to see consumer discretionary performing despite all odds. As we've discussed last week, I think this is a segment that has legs to run, right? There are many companies within this segment, consumer discretionary and retail. There are many companies there that can have meaningful upsides. Um, Nothing else to talk about. I mean, we did say that the financial sector had been on fire, right? Um, but then it gave back a lot of the gains this week. It's still up 2.6% on the month. So I think this move is still on. And anyone looking at the deregulation theme, I think Talha was looking at this. I think there are still opportunities here. So it could just be like a big risk, a big risk off slash profit taking move here. And then moving on to industries, we're seeing a little bit of a recovery within the oil segment, as one would imagine. Um, Bhavan, your favorite gold miners still underperforming. Yeah. I
Yeah.
think you had picked this company, right, as maybe one of your preferred shorts, Gold Fields. So, sure, on the week it was up, right? But I think this is a company that's showing that if the gold price doesn't rise from here, you could have meaningful downside. This company also trades at a relatively low PE, which indicates that it's not a high quality company, right? For many reasons, which as you analyze the company, you'll find out, right? So if we look at the gold price, it had a good week, but you know, it's nothing like these rallies, right? So maybe it's just consolidating and um, basically what we probably will have is a few weeks or months of consolidation, and this could even come lower because if the Fed announces that they are not yet becoming dovish, that's bearish for gold, right? Um, but on the other hand, if you have a war that escalates in the Middle East or somewhere in the world, then gold would rise as a result of higher geopolitical risk. So that's kind of the two sides of the trade, right? But I still like this as a short, right? Especially if we get to short it a bit higher from here, and we give it a bit of time, maybe around earnings. Something happens, or we could even take a timeline that's further out than earnings. It's a good pain trade to have in your portfolio, right? Um, I think it's still a valid trade, and you can see, right, the market is telling you, right, gold miners have been underperforming, both on the week basis and on the monthly basis as well. Okay, let's just look at a few industries of interest. So one of them that I wanted to look at was regional banks, and as we've discussed with the financials, these have been the biggest beneficiaries of this whole deregulation talk. Yeah. So in a nutshell, basically what the deregulation around banking and lending would look like is that banks would have to keep lower capital or would have lower capital requirements with respect to their lending activity. So what does that mean? It could mean one of two things. Banks are able to free up capital and give that back to shareholders. I think that's less likely to happen. The most likely scenario is that they keep the same capital, but then increase the lending activity. So more loans would actually create more fees, more net interest income, and that should boost the EPS of these banks. Yeah, does that make sense?
Yes, Lashan.
Okay, so we've seen it's underperform on the week, but actually if you look at the month on a monthly basis, massive outperformance. Yeah. So let's not lose track of that, right? Minus 0.5% on a week when it's done close to 9% on the month is almost nothing. Yeah. Um, Software was the worst performer. So that's the big reversal. That's down to the yield curve move. I hope you appreciate, how important that slide in the yield curve move is now, right? Because if you had figured this out, right, you would have an amazing short idea that's working tremendously, right? And in the Discord server, you would have seen me talk about the US 10-year yields over and over and over again. Yeah. And as it's unfolding, right, uh, I'm kind of giving you real time insights or views on, how I see this whole situation. Bhavan, your question, just to remind everyone, right, because not everyone had joined by that time, your question at the start of the presentation was, what do I really mean by rest in peace long duration assets? Yeah. So this is what we're seeing here. It's a big carnage in a lot of these software tech stocks, high PE, these companies that are not expected to generate a positive EPS on a gap basis for the next 2 years, right? Um, and if you think about it, right, as a trader, I think we've seen this, every now and then we have these stocks either outperforming or significantly underperforming. So we should keep a list of these stocks where we've already researched them, and then depending on how we want to play them, we have them in our toolkit, in our watch list, where we were like, okay, the long-term yields have fallen a bit, but I'm seeing a bit of risk of this going back up. And this is how I want to protect myself, right? I'm going to have a few stocks that I'm going to be short. So if you already work out your thesis and you've prepared yourself, then you're in a great position to take advantage of these moves, because as they happen very quickly, right? One day the stock is up 5-6%, the next day it's opening minus 10%. So you don't have the luxury of now trying to pick up the pieces and figure out what the story is. uh, and that's the benefit of being prepared and having all these stocks already at your disposal, well researched, whereby you can make a decision within a couple of minutes. Or, okay, let's not push it, right? Let's say within 15-30 minutes, right? Whereby you review the thesis and you're like, okay, this would be the right structure to implement. And then you go out, you execute the trade. Um, and that's what a good trader would do, right? We're always prepared. We're never panicking. We're never chasing. We're always looking at situations from a fresh pair of eyes and trying to, get the odds in our favor. Um, I think I'm finding it quite interesting that the clean energy segment is still able to rally, right? Even in the midst of regulatory hurdles, as we discussed, right? So the new bill actually removes some of the incentives for clean energy, and even with that in place, these stocks have been doing really well. Like they're 12% up on the month. On the week, they were up 2.3% almost. So, the question here um, is this just like short covering, or is there something more fundamental happening? If we look at the solar stocks, we've seen a similar type of moves. I mean, they were down on the week, but on a monthly basis, up 10%. Um, can we find long ideas here? I think definitely yes. Um, we just have to be a bit careful and make sure that we understand the business very well. I discussed a company the other day. I think I discussed it briefly. I think it's called Shoals Technologies. So let's just quickly look at what's been happening to that stock. So yeah, I mean, you can see, right? It rallied and then it managed to keep a lot of its gains. So uh, if anyone looks into their business, you'd see that they have backlogs at all-time highs, and there's a lot going on in this company. So I think the market is also looking at this and willing to give credit to the company, to the prospects ahead. And that's in spite of all these regulatory hurdles, right? Because even if this company, it's only like participating in part, in the whole clean energy value chain, it's still impacted, right? Because if capex goes down within this whole segment, then it would be hard for this company to keep growing. So this is how you need to be looking at all these situations and getting prepared with your ideas, and just waiting for the right time to get long or short. And this is literally what you need to be doing, week in, week out. It's not that complicated. Yeah, sometimes it can be as easy as that. So finally, in terms of the factor analysis, so I have this sorted by month, which is a mistake. But if we were to look at it on a weekly basis, so the biggest performer was still small cap value, followed by large cap growth. So it's uh, it's quite interesting, right? Like small cap value has been up on the month, followed by large cap growth. Sorry, followed by mid cap value and then large cap growth. Meanwhile, if we look at small cap growth and mid cap growth, they've been underperforming the market, irrespective of what we've seen, right? With all these crazy moves, the mid cap growth segment is still underperforming the market, right? So that's kind of the whole picture, right? Now, as you go along in your trade idea generation journey, right? You have to take all this context and then figure out, right, what should be the areas where, you should be looking for ideas. What are potential capital rotation opportunities slash risks, right? With the yield curve moves, I've shown you the reaction function of that, right? In that there is a big capital rotation out of a lot of these long duration assets as the yield or long-term yields start going higher. So that's how you really need to be thinking, to be forward-looking, right? And not just be in awe of, if let's say a stock has gone up by 20, 30%, not be the guy who, thinks that it's going to go another 20, 25, 50% from here. It could well happen, right? But it will happen not because you think it will happen. It will happen on the basis of, solid fundamentals. So you always have to think about it from that perspective. Yeah. Before we move to our section, I'll open the forum. If you have any questions, feel free to ask. No questions? So I'll ask you one question. Based on what we've discussed, has this given you more clarity in terms of how you're thinking about markets from here? Or has it just made you more confused? It's an important question, right? Because we also don't want information overload, right? The reason we discuss these things is to bring clarity. And I really want to know whether this brings mental clarity or if this confuses you further. So feel free to unmute and let me know.
I would say for me, it's like in the beginning, it used to be a lot of what we talked in the webinar would go over my head,
Mm-hmm. Mm-hmm.
but it's getting better and better. Like I would say about 80% of it is I can
Mm-hmm.
process it for idea generation,
Yep.
but there's still a bit of work to do. I think it will
Okay.
only
But
happen like
does
with
it
practice.
when you look at it, does it feel like, now I get it, right? It's like
It,
everything comes together and you're like able to make sense of, because I wouldn't know what stocks you've been looking at during the weekends, right?
yes,
I'm sure you're flicking through a lot of stocks, and as you're doing your idea research, you might be in segments I haven't even looked at or touched here.
actually, I did like a company. It's very interesting. I don't know if you've looked at it. It's Flex.
Mm-hmm.
Yeah, and I've been working on a thesis on this one,
That's
and
a logistics software, right? Or am I mistaken here?
no, it's a bit of utilities and all, but it's going
Okay.
into data center now. It's doing cooling
Right.
solutions and switch solutions.
Okay. Okay.
So it's
That's
remodeling the company.
seems interesting. That's the whole AI hardware theme, right?
Yes, that's because I was supposed to be looking at that.
I was thinking of a different company called Flexport, which is not the
Uh,
one. I was looking at this company also this week, AES, also another utility company.
mhm.
Um, I just skimmed through it, but y- uh, this is not what I wanted to do. So, a lot of these companies within the AI segment, um, it's probably a bit late to get long, right? Because it's already moved a lot. So before you initiate a new long idea, you really need to see, you know, fundamental improvements ahead, right? And not
Yeah,
just get long because it's exposed to a good theme and, it's been up. All of these things from the past don't really matter. It's all about the future.
yeah.
Okay. Bhavan, what's your view on the question I asked? Is this helping you? Is it giving you mental clarity? Or is this giving you more questions to that are unanswered?
No, it's giving me more clarity. Like, I can overlay what you said, like
Hmm.
based on the different industries that I was looking at
Hmm.
over the last 2, 3 weeks.
Yeah.
So yeah, it makes sense what you're
Yep.
saying, Roshan.
And sometimes you might have a day where the US 10-year goes up, but the stocks just keep doing their, exuberance, the irrational exuberance, right? And then eventually, right, it will all turn. So sometimes you might sit there for a couple of days and think that, uh, you've got it all wrong, right? Which would have been the case if you were sitting through the markets this week or even last week. But then eventually you see that it all comes back. So uh, the reason I'm saying this is because sometimes, it can be difficult to short something that's gone up a lot, right? But then if you identify the right drivers and you also identify that the macro tailwind is turning into a macro headwind, that should give you enough conviction to pull the trigger. So this is a good example, right? If we go on a daily basis, right? At some point, we even thought that, like on these 2 days, we even thought that, maybe the market will just not give credit to our thesis. Yeah.
Yes.
Because, you had 2 days of this, actually 3 days of this just rallying in your face, and it goes all the way to 356. I think we put the trade around 348 or 50, something, right?
Right.
Yeah. So, uh, on these 3 days, you're looking at this, and the US yield is also doing something, right? But the stock is not reacting. So, what I'm trying to say is if you wait for this to happen like instantly, like over a 1 day horizon, a lot of times you'll see it doesn't work this way. A lot of times, you have to wait for the retail crowd to kind of dissipate, and then eventually you'll see the price action follow through. So it's not like that. That's the thing with financial markets, right? It's not physics, it's not mathematics where you've got a formula, you stick in the inputs and you're sure to get the outputs. It's a lot more complicated, but eventually there are principles that guide the market, and eventually it just converges towards those principles. Okay?
Yeah. Maybe I have like
Yeah.
one question.
Mm-hmm.
So when we're thinking about this yield curve or yield rates going up,
Mm-hmm.
so what do you have to think about the next step where it's going to be like it's going to be holding up at these higher rates for longer and our
Uh,
idea should be based on that or should be thinking about okay the market already knows that the rates are high and only going to be coming down from here, but the duration has been shifted to a little
yeah.
bit longer.
Look, at this point, we're trading at 4.42 on the 10-year yield, right? And
Yes.
your question basically is what happens next, right? It's
Yeah.
all good showing the yield curve moving up over the last 2 weeks and all of that. But what happens next? Does this go back down and test this 200-day moving average and move further down? Or does this, just trade sideways or even go higher? Uh, I haven't checked on what's happening with the EU and the US with trade tariffs. Do you have any updates on this? I saw something on social media, but then I just did not want to look at it too seriously. Have you seen anything in the news on that?
Regarding tariff, the only
Hmm.
thing I
Hmm.
was looking at was they have a new tariff imposed on Canada.
Okay.
And like EU and China, I really haven't seen anything.
Okay. So, um, look, the US yield would go up or down depending on long-term inflation expectations, right? Um, we have the Fed meeting in a couple of weeks at the end of July. Um, I think the market has realized that the probability of them cutting is very low, if any. Um, but the market will certainly behave or react to the commentary of the Fed, depending on how dovish or hawkish they might be. So one of the dovish comments that Powell has made recently is that if it were not for trade tariffs, he would have cut already, right? So he's basically telling you that the only thing standing in the way and introducing a big question mark is the tariff situation. And he's basically told you that he wants to wait and see before he does anything. So if Trump moves the deadline to the 1st of August, it means that he has, like, Powell would be sane to say that I have to wait for at least a month or two after 1st of August to see the full impact of tariffs, right? Which means that he has the leeway to push back this whole timeline of when he has to actually pull the trigger. And I think he will use that card. He has no need or no urgency to start cutting, except from all the bullying that's happening. But if he just disregards that, or he might even get a bit more spiteful and say, okay, look, you're bullying me, so I'm gonna stick to my guns and keep doing my own thing. But let's put that aside, right? If he acts on facts, I think he'd be right to not do anything until, let's call it, September. So maybe October is when he probably has more visibility on whether to cut or not, right? Um, and if that's the situation that the market is positioning for, right? I think the yields could stay where they are or they could go higher, right? The US 10-year yield would go lower if there is more elements that point towards the Fed cutting incessantly, which is not there at the moment. At least that's how I view it, right? But if
Yeah.
let's say on Monday, right, the US 10-year yield go to 4.2, um, I don't care about my views. I'm going to look at what the market is doing, right? And then I'll position accordingly. Um, First of all, I'll try to understand whether this is a sustainable move, right? So when the 10-year yield fell from 4.2 all the way to 4.3 and even lower, I was trying to understand what's driving that, and it was basically all these bullshit narratives. Uh, and then I was trying to see whether there's any veracity in those narratives, which I couldn't find anything. And then eventually the market gave me the answer I was looking for. So, the bond market spoke clearly and loudly. Um, and I think they would continue to do that. So, if you want to be a little bit ahead in terms of equities or what equities will do next, I think this is the chart to watch. And the most important is to interpret it correctly. Yeah, because we're all looking at the same thing. It's the guys who interpret it correctly within the context that we've set. It's those guys who will win. Does that answer your question, Bhavan?
Yes. Yes.
Okay. So, I think this is the best example of when we have to exercise mental flexibility, mental thought process flexibility. I have a slide on this. Let's move to our section. I think I want to discuss. Okay, I forgot about this slide. The corporate bond spreads. Uh, we had another weeks where we saw this going lower. So the corporate bond market doesn't really think there's much wrong with corporate America. They don't really see much delinquency risks ahead, which would boost equities. Um, it's quite interesting because if this goes higher, then we'll have a reversal of that sentiment. And as the US yield go higher, I think the corporate bond market might become a little bit more defensive. At the moment, it's just like, liquidity is high. And even if we look at the primary issues, it's been a healthy market by all means, even if it's, a little bit of summer holiday season in North America, we're still getting new issues. And it's the way that the market is telling us that they don't really see a lot of risk, ahead from here. But this can always change on a dime. So, um, something to keep watching for.